Hello, this is Manish Patel from ichimokutrade.com. Today we're going to go through another trade review. This time we're going to deal with CVS, and we're going to deal with this notion that you can't go four strikes out of the money on options and make money. And I'm going to show you a perfect example of a real live trade of one that we did do that on. And we'll talk more about that in just a moment. Before we begin, this is our normal disclaimer to state this is for education use only. We're not soliciting you to buy or sell any particular instrument. If you do so, you're doing that at your own risk. All information is owned by EII Capital Group, cannot be distributed without written permission from us. All the charts you're going to see today are going to be Thinkorswim. And we're going to show you real live trades from our student account where we show you how you could make the most money off one contract. It doesn't matter how much money you have in order to trade. Okay. So let's go and begin. Let's show you CVS. So at the beginning of the year, we looked for CVS, and we looked at a lot of stocks that had really good momentum going into 2015. And you could see CVS here with really great momentum going up, and you could see from the monthly basis too, everything was bullish here. Okay, now I know a lot of people say, well, it's bullish, it could go down. Well, we're not going off that assumption at all, because things are overextended, can remain overextended for a very long time. Our goal was, if it's overextended, we want to keep our risk low. So that's kind of what we're going to do, is we're going to keep our risk low as possible. But what we're going to do is we're going to throw baits out into the market in order to see if they bite and see which way they go. Okay, so these are low risk trades, especially since this is overextended. What we're looking for in January is some type of pullback to occur. Really didn't get that towards the end of January, which is kind of where we started seeing this little red bar right here is when we started seeing a pullback. And what we started noticing was on the lower time frames and swing trading levels, we started looking for multiple time frame supports, which we got. If you come down here to a 4-hour, and see if we could even go back that far. Yeah, we could see it right here. You could see this level right here on the 4-hour that we're looking at. Remember, this is a long-term play. Okay, so let's go to the monitor tab here. This showed you January 29 of 2015, roughly around 11:20 a.m. Eastern Standard Time. We bought two options of CVS, basically $125 calls. If you look at this, and you could see from here, from the weekly time frame, the stock price was roughly a little below $100. Okay, is when we got it. So we went about $25 out of the money. If you look at CVS now, and you kind of look at the option chains here, this right here is the option chain right there. You could see now they're predicting a worst case is $11 move above here. So if you add $11 to this right here, this would be about 118. So even now today, the option traders, the way they're pricing out options is that they do not believe by January of 2016, the expiration, CVS will not be above 117. Okay, so you could see we're kind of going way out of the money here, and even today this is 4 strikes still out of the money. Okay, but what we're looking for in this scenario is, you could see we did it right before earnings here. So we got 1, 2, 3, 4 earnings that are going to take place before our option expires. And what we did was we found these options really cheap, to a point it only costs us 79 cents for per contract. Okay, so you could see here we got the 79 cents per contract right before earnings. CVS, the last earnings that just came out last week, I believe, which was at August 4th. We closed out one of those options for a 128. So we basically made some really good, nice profits. And the reason why we did that is that we wanted to reduce our risk on one of those contracts completely. So we wanted one contract to keep on going, and what we wanted to do was get that close to break even. You could see we made about 49 cents on this one. So our cost basis for the first one now, if you take the profits from that one, because remember we only sold one here, is that this is now down to 30 cents, and you could see this is still profitable right now. So if you do not believe you can make money 4 strikes or 5 strikes out of the money, you can, as long as you know how to read a technical chart and also you understand the Greeks. One of the reasons why we were able to make money on this is that when we bought this option, it was low volatility, and what we did was not only did we get a price movement going up, but we also made money off volatility. So you have to understand how to read the charts, and you have to understand the Greeks, two things that we cover in our university programs that we offer. If you guys have any questions, feel free to email us, but this is a perfect example how you can sit there and make money going 3 or 4 strikes out of the money, believe it or not, and that's based on technical charts. Remember, most people that come up with that notion don't know how to read a chart, and that's one of the things is if you do know how to read a chart, you can sit there, go 3 or 4 strikes out of the money and keep your risk low. Thanks. Bye.